Trimpa is taking on the Federal Reserve, and that's why gold, silver, and Wall Street are suddenly falling. This market drop didn't start with inflation data. It didn't start with earnings. And it definitely didn't start overseas. It started with a power signal from Washington. Because when a sitting US president openly challenges the Federal Reserve, not quietly, not indirectly, but in full view of the markets, everything reprices at once. And that's exactly what we're watching unfold right now. The rally that looked unstoppable. Just days ago, markets were celebrating. Gold was surging toward historic highs. Silver was ripping higher at a pace rarely seen before. Stocks were holding up despite global uncertainty. Silver, in particular, had gone vertical. One of the strongest monthly moves in decades, enough to make even seasoned traders uneasy. Gold wasn't far behind, climbing at a rate not seen since the late 1970s. This wasn't speculative hype. This was fear-driven positioning. Investors were hedging against debt, deficits, geopolitical risk, and long-term currency erosion. Then, almost overnight, the tone changed. Gold slipped, silver sold off sharply, US stock indexes turned red. And the reason wasn't economic, it was political. Why one announcement changed everything. President didn't announce a rate cut. He didn't sign a new law. He didn't launch tariffs. Instead, he named his future pick to lead the Federal Reserve. That single move was enough to send shockwaves through global markets. Because the Federal Reserve isn't just another institution. It controls the price of money. Now, why the Fed chair is one of the most powerful jobs on earth. The chair of the Federal Reserve decides how expensive borrowing is, whether inflation cools or accelerates, whether asset prices inflate or deflate, whether the dollar tightens or weakens. Interest rates affect mortgage payments, car loans, business investment, government debt servicing, global capital flows. Every major market, stocks, bonds, real estate, gold, silver, crypto, responds to what the Fed does next. And that's why markets pay attention not just to rate decisions, but to who controls the chair. President versus the Fed, a long brewing conflict. President has never been subtle about his views on interest rates. From Trump's perspective, rates are too high, borrowing is too expensive, growth is being throttled. President believes lower rates fuel expansion, boost markets, and keep the economy running hot. The Fed sees it differently. Their concern is inflation. Cut too aggressively, and inflation comes back stronger. Once inflation expectations reset higher, they're incredibly hard to control. This disagreement has been simmering quietly. Now it's public. Why this feels different from past disputes. Here's what makes this moment unique. The president isn't just criticizing the Fed. He's signaling a future change in control. Legally, a president can't fire the sitting Fed chair mid-term, but president can do something almost as powerful, announce the replacement early, and that's exactly what he did. By naming his preferred successor months ahead of schedule, President sent a message not just to Powell, but to every investor, bank, and government watching. Monetary policy could soon look very different. Markets don't wait for changes to happen. They move on expectations. Why gold and silver reacted first? Many people saw gold and silver falling and assumed the trade is over. That's a mistake. This wasn't a collapse of confidence. This was repositioning. When investors sense potential changes in interest rate direction, Fed independence, political pressure on monetary policy, they take profits, they reduce exposure, they reassess risk. Gold and silver had run hard. Fast money stepped aside. That doesn't invalidate the long-term case. It highlights how sensitive these markets are to policy shifts. ETFs. Tell the story, the headlines. Miss. The real signal wasn't spot prices, it was ETF flows. Gold and silver ETFs saw sharp outflows as investors locked in gains, reduced short-term exposure, and waited for clarity. ETFs amplify moves both ways. When sentiment shifts quickly, prices follow. But here's the key point most headlines miss. This selling wasn't a tea about weakness, it was about uncertainty. Why Wall Street didn't like this either. Stocks reacted negatively for the same reason. Markets are fine with bad news, they're fine with high rates. They're even fine with inflation, as long as it's predictable. What markets hate is uncertainty about who's in control. If investors believe the Fed may cut rates faster than expected, political pressure could override data, or monetary policy may become less predictable, they demand a higher risk premium. That means lower stock prices. The real fear, Fed independence. At the heart of this story is one concern. Will the Federal Reserve remain independent? Central bank independence isn't just an academic idea, it's foundational to trust in a currency. If global investors believe the Fed answers directly to political pressure, confidence in the dollar weakens. That affects treasury markets, capital inflows, exchange rates, and commodity prices. This is why foreign investors are watching this closely. It's not about President personally, it's about precedent. Why this isn't just a U.S. story. The US dollar sits at the center of the global financial system. Oil is priced in dollars. Debt is issued in dollars. Trade is settled in dollars. Any perceived shift in how US monetary policy is governed ripples globally. That's why Asian markets reacted, European investors took notice, and commodities moved. This isn't isolated. 3 paths forward from here. Markets are now watching for signals. There are 3 broad scenarios. Scenario 1, stability holds. The Fed stays firm. Policy remains data-driven. Markets digest the shock and stabilize. Scenario 2, faster rate cuts. Pressure mounts. Cuts arrive sooner. Stocks rally short-term. Inflation risks return. Gold and silver regain momentum. Scenario 3, escalation. Political pressure intensifies. Confidence cracks. Volatility spikes. Hard assets reprice sharply higher. None of these paths are smooth. Why this pullback doesn't end the precious metal story. This move doesn't invalidate gold or silver, it reinforces their role. Precious metals don't just respond to inflation, they respond to confidence in monetary governance. When policy becomes politicized, hedges matter more. History shows us this pattern clearly. Short-term volatility followed by long-term repricing. The bigger shift few are talking about. This isn't just about rates, it's about power over money moving into the spotlight. For decades, monetary policy happened quietly, behind closed doors, in carefully worded statements. Now it's entering public political conflict. That changes how markets behave. Gold and silver didn't fall because they failed. They pulled back because the rules of the game may be changing. When control over money becomes contested, markets don't move in straight lines. They move in shocks. If you want calm, research-driven breakdowns of what is really happening beneath the headlines and why it matters for your money, make sure you subscribe to the channel, because the next phase of this story is going to be even bigger.